You are watching Market Pulse Daily. Today is Monday, June 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Markets are navigating a complex landscape of escalating oil risk from the U.S. Iran conflict, a narrow AI-driven equity rally, and weakening crypto liquidity. Today's agenda: market snapshot, macro and central banks, geopolitical status, commodities and crypto, what to watch next. Let's get a quick pulse on where the markets stand right now. Good morning. The market is currently navigating a complex set of signals. On Friday, U.S. stocks ended the week on a high note, pushing the S&P 500 to close at 7,580, with the Nasdaq Composite and Dow Jones Industrial Average also showing gains. Futures markets suggest this positive sentiment may carry over. However, beneath the surface, the U.S. 10-year Treasury yield is holding steady around 4.5%, indicating that interest rate expectations remain firm. Simultaneously, oil prices are climbing, with WTI crude near about $90 a barrel and Brent around about $93. This rise is directly linked to escalating geopolitical tensions. Gold is also seeing activity, trading between about $4,510 and about $4,535. The dollar index is currently around 99. This mixed picture means investors are trying to price in three major forces at once: the potential for higher oil prices due to conflict, the ongoing AI-led equity rally, and concerns about crypto market liquidity. The market mood is mixed, but not yet panicked. The key takeaway here is that the same environment that might support energy and defense stocks could put pressure on bonds, long-duration growth stocks, and digital assets. We're watching for any decisive moves in oil and yields to understand the market's dominant narrative. Now let's look at the bigger economic picture and what it means for central. The big picture economy is currently dominated by the risk of inflation, and the main culprit is energy. This isn't a sign of a booming economy with high demand. It's a supply-side shock, potentially triggered by events in the Persian Gulf and disruptions to shipping routes. For the Federal Reserve, this is a very uncomfortable scenario. When oil prices jump, it can push inflation expectations higher, even if the underlying economy isn't growing strongly. Higher oil prices also tend to boost the U.S. dollar and push bond yields up, which narrows the room for the Federal Reserve to signal that they might cut interest rates soon. This makes their job of bringing inflation down to their target much harder. Investors are now laser-focused on upcoming U.S. economic data. We'll be looking at manufacturing surveys, job openings, private payroll numbers, and weekly jobless claims. But the main event is Friday's non-farm payrolls report. Current forecasts from Reuters suggest around 85,000 new jobs were added in May, with unemployment holding steady near 4.3%. The official numbers from the Bureau of Labor Statistics drop on Friday morning. The question for equities is whether strong jobs data will push yields even higher. For bonds, the concern is whether energy inflation will keep longer-term interest rates elevated. And for gold and crypto, the key driver remains real interest rates and the availability of cash in the system. Keep a close eye on these jobs numbers and any commentary from central bankers about energy inflation. Let's pivot to the geopolitical front, which is directly influencing energy. Turning now to the geopolitical landscape, the situation between the U.S. and Iran remains the dominant risk factor. Recent reports confirm U.S. forces conducted strikes on Iranian radar and drone command sites. This action followed Iran's shootdown of a U.S. drone over international waters. Iran's Revolutionary Guard has stated they responded by targeting a U.S.-used airbase, and Kuwait has reported intercepting incoming drone and missile fire. This is not a distant political issue. It has immediate and direct consequences for global energy markets, shipping lanes, and inflation. The market's focus remains squarely on the Persian Gulf and the critical Strait of Hormuz. If shipping flows are constrained there, the impact extends far beyond just crude oil. We could see effects on liquefied natural gas, refined products, insurance premiums for tankers, and even the supply chains for fertilizers. China, a massive energy consumer, is already feeling the pinch. Their seaborne crude oil arrivals in May dropped to their lowest level since October 2016, showing how sensitive these supply chains are to regional instability. Russia and Ukraine continue to be a secondary energy security concern due to ongoing drone attacks and sanctions enforcement. The market impact is clear. Brent crude trading near about $93 a barrel reflects a significant risk premium. This means defense and certain energy companies could see benefits, while sectors like airlines, chemicals, and consumer goods, as well as energy importers, face higher costs. The dollar is getting some support as a safe haven, but gold is caught between this geopolitical uncertainty and rising treasury yields. We are watching very closely for any signs of de-escalation or further escalation in the Gulf. Let's zoom in on commodities and the volatile world of cryptocurrencies. Let's turn our attention to commodities and cryptocurrencies. Oil prices are providing the most direct signal of geopolitical risk today. With WTI crude near about $90 a barrel and Brent around about $93, the market is clearly factoring in the possibility of supply disruptions. If these prices continue to climb, it will directly impact transportation costs and feed into inflation expectations, making central banks even more reluctant to consider lowering interest rates. Gold is finding some support from the current geopolitical uncertainty, but its upward movement is being held back by a stronger U.S. dollar and rising treasury yields. Silver is holding its ground near about $75, benefiting from its dual role as both a precious metal and an industrial commodity. Now, for cryptocurrencies. The story is different and centers on investor flow. CoinDesk reported that U.S. spot Bitcoin ETFs have experienced a record streak of outflows, with roughly about $2.8 billion pulled out by May 29th. This trend appears to be continuing, indicating a significant weakening in demand for these investment products. While Bitcoin's dominance is around 57 down about 59% and Ethereum's around 9 down about 10%, the overall message from these outflows is that capital is moving away from crypto, or at least from these ETF vehicles. Investors should treat the exact streak count as time-sensitive, but the direction is clear. ETF demand has weakened. We'll be watching these crypto ETF flows very closely to see if they stabilize or worsen. So, what are the critical events and data points we'll be tracking in the next? Looking ahead over the next 24 to 72 hours, there are several critical items on our radar. First and foremost, we'll be watching for any confirmation or breakdown in the U.S. Iran ceasefire talks. This will have immediate implications for energy markets. Second, we'll be monitoring tanker movements, insurance costs, and any shipping headlines emerging from the Strait of Hormuz. This is a direct measure of how the conflict is impacting global energy supply routes. Third, the price action in Brent crude oil and the U.S. 10-year Treasury yield will be key indicators of market sentiment and inflation expectations. Fourth, we have a packed economic calendar. We'll see ISM manufacturing data, JOLTS job openings, ADP private payrolls, and weekly jobless claims, all leading up to Friday's crucial non-farm payrolls report. Fifth, pay attention to any commentary from Federal Reserve and European Central Bank officials, particularly their views on energy inflation and its potential impact on monetary policy. And finally, sixth, we'll be closely tracking crypto ETF flows, specifically whether the current outflows from Bitcoin ETFs stabilize or accelerate. These are the key catalysts that will shape market direction in the short term. Market mood is resilient but fragile. While AI momentum supports equities, rising oil prices and geopolitical risks are creating headwinds for easier financial conditions. The biggest risk is a renewed energy shock that could push oil prices higher and increase yields, limiting central bank flexibility and pressuring rate-sensitive stocks and crypto. Opportunities remain in AI infrastructure, energy, and defense, but market breadth is a concern for now. This is a repricing of oil risk, interest rate risk, and crypto liquidity, not a broad market panic. We'll be watching ETF flows, the Strait of Hormuz, and the breadth of the AI rally. Thank you for your attention, and we will see you again tomorrow.